tax bill, given that that's sort of top of mind this week for a lot of people. What's your view?
It's a moral abomination.
Not one to mince
It's
words.
an experiential abomination. And on the experiential side, I mean, just think about this. Corporate profits after taxes last year were the highest they have ever been in the history of the GDP, going back to 1929 or something. The highest ever. And we're thinking about giving relief to the corporations at the highest levels ever.
स्टॉक मार्केट रिलेटेड इंटरव्यू वीडियो पाने के लिए मेरे चैनल को सब्सक्राइब करें और बेल आइकन को दबा दें.
Individual wages are at the lowest level in about 15 years as a percentage of GDP. So we're helping the people that are doing very well and doing nothing for the people that are doing very badly. And one of the flaws is that corporations are putting, I won't get into my philosophy too much, corporations are putting their shareholders ahead of the people that built the corporation. That is, the people that put their heart and soul on the line and are committed to the company and come to work every day and make things work. The actual working guys, the working stiffs, of whom I still consider myself one. So it's just the unfairness. And one might ask, relative to this, how did we ever get going down a track where the money people earn by the sweat of their brow, more or less, is taxed at a higher rate than the money that people get dividends for which they do nothing? It didn't used to be that way. There was so-called unearned income tax, much higher. It got up to 70% at the end of World War II, and it prevailed for 7 or 8 years. But that's a kind of a wrong-headed thing. But the worst part of it is that the companies are making so much money now that they don't know what to do with it. They aren't investing in new equipment and all those things, innovation, whatever it might be. They're buying back their own stock. And this helps the stock price, which helps the capitalists. And I'm all for capitalists. Heck, I'm a capitalist myself. But there's such a thing as too much. I did write a book called Enough, not to be confused with the biography of Donald Trump recently written called Never Enough.
Ouch. All right, well, with that, maybe we'll open it up for questions. We've got a couple mics on either side, and if you can just, we'll start here, announce yourself as you pose your question.
Thank you very much, Ron. I'm Charles Cobb with Disrupt DC. A comment and a question. The comment is a suggestion. Would you please share with John McCain what you just said about the tax bill? The question, how do you change Wall Street's time horizons to move more from short-term thinking to longer-term thinking? Thank you.
Well, I fall back a lot of the time on Adam Smith, who wrote his stuff, as it were, in 1776, more or less. And I rely on the invisible hand of the investor to do what's best for himself and therefore change the world for the others. The matter is not in Wall Street's hands. The matter is investors' hands. And if brokers or firms or mutual funds that trade too much are doing the clients a disservice, this will become very apparent and the clients will move their money. That's why we had this huge move into indexing, which is now, I think, 40%, almost 40% of all mutual fund, equity mutual fund assets. Wall Street is a great marketing machine, a great selling machine. And if stocks don't trade, Wall Street makes no money. There was a cartoon in Barron's some years ago with a sober-looking announcer from CNBC saying, there was no trading on the New York Stock Exchange today, as all investors were satisfied with their positions. And that's the Nirvana day that I'm looking for. Because we trade with each other. There's no gain to be found for the market. I trade with you, I may be right or wrong, you may be right or wrong. And there's only one person that makes money, the croupier in the middle. So people will get wise to that, and they will get wiser, kind of the example I gave at the beginning, when returns are lower. Cost, 1%, 2%, let's call it 2%, of a 4% return is half of it, where of a 15% return, we enjoyed 17% actually in the 80s and 90s, it's only 10, you're still left with 15 after the 17% returns for each of those 2 decades, unprecedented in American history. So experience will tell, and they will be moved by what the customer wants. what the client wants. So there should be less trading, even as we bring the exchange-traded fund into a whole new world. Now, ETFs account for somewhere between 30 and 40% of the trading in the New York Stock Exchange every day. There has to be something to sell all the time in Wall Street. And you know, with all due respect, I mean, it's an honest trade, but there's just too much of it going on, and it can't win. Because if trader A wins, I mean, I don't want to beat this to death, but I might as well make it clear. Trader B loses. And so trading is a loser's game and relative to the stock market.
Let me follow up, if I may, just on that point before I take another question. That let's say everybody's indexed. There still may be policy work to be done in terms of bridging that divide you're talking about between corporations, their wealth, their incentivization to invest in productive uses of capital, and the labor share, which is at post-war lows. How do you bridge that gap? How do you, I mean, should buybacks be illegal like they were pre-82? What else can we do to really encourage people to invest that capital hoard? And I was a little bit surprised. I mean, I'm sure many people saw the Wall Street Journal CEO conference where Cohen was asked, who's going to invest if we get this repatriation through, and only about 3 hands went up, which was really disheartening. What do you say to that?
Well, indexing has some limit. I don't have any idea what it is, but it certainly could easily be 90% of all stocks, and the market would still work fine. It's easy to say, as you read in the Wall Street op-ed yesterday, that the market will then get inefficient, start to get inefficient as you creep into the 80s and 90% that's not traded, just means a reduction in trading volume. But the reality is that it may get less efficient and it'll be much easier to win. But it will also be much easier to lose, because the average manager is always going to do the same as the index because they own the same stocks. That's what the market is. It's a universe. This much is indexed, this much is held by active managers. So you will probably see at some point a division between, if you get way out there, years and years, decades from now, the market does get less efficient. But it doesn't, it will make it easier to lose and easier to win. You can never look at the market without realizing that for every buyer there's a seller. It's a very kind of simple thing that people seem to forget. So I don't worry about that. I do worry about the lack of competition in indexing. The big three, so-called, you mentioned Vanguard and BlackRock and State Street, there's very little competition. We Vanguard are 80% of the traditional index fund market, and nobody wants to compete there. The competition is over in the exchange-traded market, which is a very different piece of cake, and not as good one, I'm sure, not as good a track to be on at all for the investor. And so why don't more people join? Because all the damn money goes to the investors and not to the managers. It's not an attractive business proposition. And the mutual fund industry is basically an industry that is trying to make money on the return of the manager. And of course they want to make money on the returns of the people that invest with them, but they're greatly handicapped by the fact that their prime job is to run a corporation in the traditional way, see how much profit you can make. And the more the manager takes, the less the investor makes. This is just the truth.
Okay, let's take another question. Here in the sort of middle there.
My name is Les from Alpine. I was in Omaha when Warren Buffett called you the greatest hero to the American investor for
go on with it.
for a lot of your work that you did on what I guess we call traditional asset management. But plan sponsors, nonprofit institutions, and now even retail investors are being increasingly exposed to alternative asset management. So my question is, what's your current thinking about alternative asset management, i.e. hedge funds, private equity firms? And from a fee perspective, what do you think is a perfect fee model, since you were so good with the fee model 40 years ago?
Well, those are big questions. Let me start off with the fact that I limit my own investing universe and the universe I recommend to the investors who read my books and so on to stocks and bonds. I don't see any magic in hedge funds. They had very good years when they were young and not much competition. And then they ran into about the last 5 years, and it's been easy to outperform them in a balanced index fund, simple 60-40, unmanaged, passive balanced index fund. And I think their day is past. It could come back for a while, but in the long run, you heard it here, everything reverts to the mean. And that's just the reality of investment life. Right now, I say this a little nervously, at Vanguard at $4.5 trillion, give or take, is bigger than the entire hedge fund industry at around 2.8, 2.9 trillion, I think is the number. So they haven't done much growing or had much success in reading here. Private equity, I just don't see that that's the road, road to free riches, wealth without risk. There's no such thing as wealth without risk. And you look back at some of the big ones, like the Texas utilities, 55 billion privatization, and it goes bankrupt. Too much borrowing. As interest rates go up, if they do, all this private equity will, and all that easy leverage, if you will go away. So I would limit myself as an investor to stocks and bonds. Every time is an easy way, I put my hand over my wallet pocket, because there is no easy way. This is a hard business to win at, very hard business to win at. And if you want to make a lot of money while you're doing it, it's probably an impossible business to win at.
Okay. Question back here.
Hi, I'm Strauss Zelnick. Some thoughts on Bitcoin?
Talk about speculation. Oops, sorry.
Bitcoin. Well, Bitcoin is a currency. Bitcoin has no underlying rate of return. Bonds have an interest coupon, stocks have earnings and dividends, gold has nothing, and Bitcoin has nothing. There is nothing to support the Bitcoin except the hope that you will sell it to somebody for more than you paid for it. I think that's a factually correct statement. How much of Bitcoin is criminal? People that want to hide their transactions. Some people say it's large, some people say it's small. I don't really know the answer to that question. But I would say avoid Bitcoin like the plague. Did I make myself clear?
You did. A question over here.
Hi, Patricia Duff from The Common Good. You've had such a great record as being fair to the investor. I wonder if you will comment a little bit about other regulatory issues such as financial responsibility, fiduciary
Advisors from having a fiduciary duty to their clients. We all think it may be there and it may not be there. It's not codified anywhere. But we have to have, I would say, fiduciary duty should apply to anybody that touches $1 of other people's money. So it should be vastly expanded. And I think it eventually will be. And that should have the happy result of making those of us who are going to be controlling American business, that is to say, large investment advisory organizations, which already owns something like 22%, I think it is, of all stocks, to exercise fiduciary duty in our voting the shares of the proxies, in our putting in proxy proposals. And I've got to say, slight commercial, I don't mean to do too much of this, but Vanguard is doing from a long way back, and I was very critical of the present management for a while, but I've come so long a way back to beef up our total response to the responsibility. What is the responsibility of a fiduciary in a corporation, a fiduciary owner representing others? And that is to make sure the corporation is run in the interest of its shareholders and not in the interest of its management. It's not to tell them to do this or not do that or get out of this line of business or whatever it might be. It's to make sure the company's run in the interest of the management, in the interest of the shareholders, not in the interest of the management. And I think we will get there. Not in my lifetime, but we will definitely get there. And we'll see an environment in which large institutional investors, which I don't think there's any way to really break up, any sensible way to break up, will be, and there may just be a larger number with smaller units or a smaller number with larger units. But governance will change when we have institutions that care, institutions that are stock owners and not stock renters, like the stock market today. And so the index fund turns out to be the answer to better governance.
Do you want to comment on CFPB at all and what the administration is?
I read with amazement, who's in charge here? I don't know if they have 2 desks. They used to have I have a little like a partner's desk. I only use half of it. I guess these man and woman, I think they are, come in every day and greet each other happily and try and run the bureau. I have no idea about the legalities of all that, but I would suspect that given political pressures and all, that the administration will win and get its person running the Consumer Financial Bureau. And like all of the bureaucrats down there that are appointed, their first task seems to be to get rid of the bureau they're in charge of. Well, I mean, you know that's the case, and you know, you see it in health and all the other things, and it's not healthy. We do need the government badly, and I'm always amused to see nobody wants government. They don't want a standing army to protect us. They don't want a fire department. Get government out of my life. They don't want their Social Security. I mean, who's kidding who?
Yeah, people don't like government, they like government programs, I think. Way in the back here.
THK in Hong Kong. Jack, would you address in the abomination that is the tax bill, the question that is raised on the other side, that the pass-through is important and that small business, with the tax going to the owner, the individual, is in fact going to have some effect on investment? Secondly, what about all those earnings abroad? If you lower the repatriation tax, will they come home and be invested?
Those are the 2 tough questions. I mean, it seems to me the first one you can deal with by the terms and conditions in which it's possible to get the pass-through, and you can make that as easy or as difficult. I'm not sure about the detail of the law that does that, but I think it's still possible to get the pass-through if you're willing to go through all the bureaucratic hoops. As to bringing the money back from abroad, there's got to be some way to do that, but I don't think it's a wholesale reduction in corporate taxes. And who says 20% is a better number than 25%? Who says 35% is the existing number, the existing tax rate, when everybody in the room knows that most corporations pay less than 25%? It's just a false standard. Our corporate tax rates are very competitive with the rest of the world in terms of actual effective tax rates as compared to stated tax rates. So we could do so many improvements in the law that they're not doing. We can make it clear, we can make it simpler, and it reminds me of I was on a panel, not a panel, but a joint conversation with a television reporter with Paul Volcker, and I was talking about how easy it would be to fix Social Security. Just a little adjustment here, wage adjustment, inflation adjustment, bring in different outside pension funds, that sort of thing. And I said, you know, to the moderator, I said, if you would let Paul appoint Paul and me as czars, we could fix it in an hour. And Paul Volcker looked up and said, couldn't we fix everything?
Okay, question here in the front.
Gerald Pollack. At the annual shareholder meetings of corporations, the large mutual funds generally support management and do not involve themselves with the shareholder resolutions. Should the large shareholders, such as Vanguard, be more active in looking into the merits and demerits of the various shareholder resolutions?
Great question.
Well, the answer to that is yes, they should be, and yes, we should be, speaking specifically for Vanguard. But we have gotten really an incredible step up in what we are in fact doing. We, Vanguard, on the proxy front, we put out a report about a month ago. It must be 12 or 14 pages showing how we voted each way on every significant issue that came up. We have a staff, believe it or not, of about 33 persons who work on nothing but corporate governance issues. We don't try and analyze the financial side of the corporation, but things where as the sort of threadbare saying, where the rubber meets the road, of which the biggest is executive compensation, which has gotten so much out of hand that if you came in here and hadn't looked at it for 30 years, you'd say, this is crazy. Well, of course it's crazy to pay the executives so much, as if they did everything. You know, I've been a chief executive for more chairs and a board chairman and everything else for more years than I care to count. And I know you can only do so much. I know the real work is done by the people that are doing the day-to-day work in the company. And why they get less and less is I get more and more. That's not the way we worked at Vanguard, by the way, at all, because I'm very conscious of this. But it's just, it's ego. It's, to use a recent example, it's having a backup plane when you. I mean, Ross Johnson in the Nabisco thing had a special jet for his dog. To be fair, I think there were 2 dogs.
Question, let's see, was there a question in the back there? Yeah.
Sandra from Tencent, China. 2 questions. First of all, even though right now we are like 10 years away from financial crisis, there is still a lot of risk in global economy. So let's say, what worries you the most that could ruin the whole market if we talk about the global economy? The second one is, in your book, you mentioned the funny account before. So basically, an investor can have like 5% in your portfolio to have some kind of speculating investment. So with a heart of 50-ish, what kind of asset class maybe you are thinking to put some, funny accounts? Thank you.
Well, on the second part, I've often said, a little bit tongue-in-cheek, that part of the romance of investing is the gambling instinct that we all seem to have, or that so many of us seem to have. And so you ought to have a funny money account, not a penny more than 5% of your assets. Do anything you want with it. Buy a stock, buy a commodity, buy a Bitcoin if you want to, if you're crazy. And by the way, the Bitcoin may well go to 20,000, but that won't prove I'm wrong. When it gets back to 100, we'll.
How about a Chinese equity? What do you,
Sure.
or a Chinese tech stock?
In the funny money account, anything you want. One requirement: look at it after 5 years and compare it with your serious money account. And if you're doing much better, you may be some kind of a genius, but I'd stop anyway. And if you're doing badly, just realize this is a hard business and don't go any further. So I don't know how to go beyond that, and you're going to have to repeat for me, poor old me,
Well,
first part of the question.
She was asking about global risks, and I'd love to expand on that and ask you in particular about China, because I know that's something that you've occasionally thought about.
Well, let me tell you how I got a letter about 2 years ago, a year and a half ago, from obviously a young man, and he was concerned about his asset allocation. And he said he thinks about all the risks out there, and he can't figure out what to do. So I wrote him a letter, and I ended up ending one of my chapters in the book with this letter. And it said essentially, look, you're young and I'm old and experienced, and neither of us have any idea the outcome of the big risks that we all face today. Nuclear war, religious war, global warming, trade wars, pandemics, the breakdown of governance in our country. You can name a lot more, and every one of them is worrisome, and every one of them, this, let me say, 28-year-old young man has every bit as good idea and ability to predict the outcome of those things as I do, or as I think anybody in this room does. We just don't know. So I would put that aside in my asset allocation. And then I said, this sums up the way I deal with risk. I said, I'm 88 years old, actually 88 and a half, and I said, I'm about 50% in stocks and 50% in bonds, and that satisfies me. And yet I spend half my time wondering why I have so much in stocks and half of my time worrying about why I have so little in stocks. And that is the fog of an investment strategy that we never really know. So I think scientific things, mathematical calculations, I would fall back in the name of yet another one of my books called Don't Count on It.
All right, you're hedging very, very well. We'll move on. Question here.
Thank you. Joel Mentor, Barclays. I just want to get your thoughts on the continued viability from your perspective of the 401k as an investment and retirement savings vehicle. Thank you.
And the 401k, the thrift plan, in those couple of words, I've told you the big problem. And that is the 401k was designed as a thrift plan and not as a retirement plan. So we've turned into a retirement plan now as pension funds move back, as corporations cut back on their pensions, of corporations and state and local governments, a huge part of this whole issue, are starting to think more and more about going to defined contribution retirement plans, if you will, but they are thrift plans at the moment. So we have to change the rules of the game for the 401k and turn it into a retirement plan, or at least have a retirement plan option and a thrift plan option separately. You simply cannot allow withdrawals from any sensible retirement plan. Think of how much your Social Security would be worth if you're sitting in New York City, let's say, with an income below the median here of $25,000, and you have some needs, and you'll take it out of you have to have a hazard, an emergency withdrawal from your 401k, and you can't do that from Social Security. There would be no Social Security left at the end. So you need much more discipline. You also need a plan in which costs are a prime consideration. You know, the industry, the makeup of 401k plans is generally as a group, the total stock market is there one way or another represented. It's going to look just like the total stock market. And you're paying 2 to 3% a year. Let's use the 2 again. If you own the total stock market, by owning the total stock market as such, you're going to pay 4 basis points. There has to be cost considerations. And I would even say there has to be some sort of a board that says, yes, you can be admitted to selling a retirement plan or 401k plan if you meet these kind of standards. These kind of funds that are not wild and crazy, I don't know how to define that too well. These kind of funds that have lower costs, these kind of funds that have had management in place for X period of time, and maybe a few other standards that you would like. So it needs, for the want of a better word, the 401k needs a lot of discipline if we're going to turn it into a retirement plan, or since we've turned it into a retirement plan. So, you know, it's a good idea. It's not an unusual idea, but it's a good idea, and it works. But it works as a thrift plan, and we have to turn it into a retirement plan with the kind of discipline that people do not like to have. But if you're going to invest for retirement, you're going to have a lot of discipline, or a lousy retirement. It's your choice.
All right, well, in the minute or so we have left, because you have a 26-year-old heart, I can ask you, are you going to keep working for the next 10 years? You're going to hit the golf course at some point. What's the story?
Well, my golf vanished. And
You're going to write another book? What's the future hold?
Well, I am writing another book.
Yeah?
And I'll just say a word about that. I'm starting that as soon as I got this one finished. I started my next one, which will be number 12. And it's going to be kind of a history of Vanguard, a history of each of the major funds, some things I've written that I think are worth reproducing, Adam Smith and Modern Capitalism, balancing professional and business interests in finance, a long monograph I did for the Financial Analyst Journal, and 3 or 4 other. And then it's going to be kind of a memoir of things that I probably shouldn't say. And
ooh, that sounds...
not bad. I'm going to hide them. You're going to have to read carefully. And I think I'll say it all. This is a good way to end. I didn't want to give it a financial title because it's really much more than that. It's about a whole change that I have had a lot to do with in the whole nature of investing through the index fund and through the not yet copied Vanguard mutual structure. You understand that Vanguard doesn't have an outside manager, doesn't pay. And when you look at the fund industry, and you look from afar, you're a man from Mars, say, or a woman from Mars, to be fair, and you look and here are billion-dollar, trillion-dollar fund complexes that need to go out and hire an outside manager. You mean a trillion-dollar firm can't run itself? You've got to be pulling my leg. So you've got to start with an outside manager, and at some point the child grows up, and the mutual fund child will grow up, and there will be more mutuality where the funds are run in the interest of their shareholders. So in any event, these ideas, the mutual idea, the mutual structure, the index strategy, are eternal. So the title of the book, it's the last line of this couplet. The trees I planted still are young. The songs I sang will still be sung. So the title will be The Songs I Sang Will Still Be Sung. And I will have to give credit to the author, Johnny Cash.
Jack,
Thank
you
you all.
are the best. You rock. Thank you.